On December 6th, 2025, silver sits at $59.32 after ripping through every record ever set. But that's not the part that stopped me in my tracks. At the exact moment silver was exploding, JPMorgan quietly shifted roughly 169 million ounces into their vaults. Industry sources say that's close to 9% of the world's entire supply. And here's what makes that even wilder: this wasn't spontaneous. JPMorgan has reportedly been stacking silver since 2011-14, straight years of accumulation, almost entirely under the radar. It forces a question no one in mainstream finance seems eager to answer: if silver is as insignificant as the experts keep insisting. Why is the most powerful bank in America scooping up an ocean of it? The more I dig into this, the more convinced I am that something bigger is taking shape. What I've been studying isn't a theory, it's a recurring pattern I found woven through every major financial crisis in modern history, and it has never failed to show up before a breaking point. What worries me is how perfectly today's silver market seems to fit that pattern, almost like we're watching the final pieces snap into place in real time. You still have options, but the window looks like it's narrowing faster than people realize. Before I go any further, I need to be clear, I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with any institution mentioned here. What follows is my independent analysis based entirely on publicly available information. This is an educational breakdown based entirely on public data, nothing more. For months, I've been combing through the history of financial failures, and one thing keeps jumping out at me: every major collapse, no matter the decade or the players involved, follows the same four-stage progression. It's eerie how consistent it is. And what's been keeping me up lately is how unmistakably silver seems to have entered the final stage of that pattern. Let me walk you through how I'm seeing it. Stage 1, what I call the setup, begins when the system manufactures the illusion of stability. Prices get muted, paper instruments multiply, confidence becomes the product. For silver, this phase traces back to the aftermath of the Hunt brothers saga in 1980. Regulators, rattled by the volatility, built an enormous paper-based framework around the market so large that some analysts estimate it ballooned to nearly 50 times the size of the actual physical silver market. What really hits me is a number tucked inside published COMEX data: open interest equal to roughly 244% of vaulted silver. Think about that. If even half the holders of these paper claims asked for real physical delivery, the math simply wouldn't work. The system would be strained almost instantly. And that's the entire point of stage 1, a market that appears calm only because it's sitting on top of a structure designed to keep the lid on. Stage 2 is where the gap between paper silver and real silver blows wide open. Debt ramps up, money printing goes crazy, and the market gets buried under layers of financial promises, yet the price of silver barely moves. And honestly, we've been stuck in this phase since 2008. Central banks pumped more than $30 trillion into the global system. The UE alone added about $8 trillion. With that kind of liquidity, silver should have blasted off. But every time physical demand picked up, big banks reportedly drowned the market in paper contract shorts, derivatives, synthetic supply. That's how silver spent nearly a decade locked under $30. Meanwhile, real-world demand was heating up. Silver is critical for solar panels, and EVs need 3 times more silver than regular cars. Add 5G, AI data centers, and medical tech, and it's no surprise industry now accounts for about 59% of all silver use, up from 40% 10 years ago. But here's the problem: supply isn't keeping up. Mining data shows production down roughly 7% since 2016. Analysts call it a structural deficit because for 7 years straight, the world used more silver than it mined. The extra comes from above-ground stockpiles, vaults, and reserves getting drained year after year. Look at India's record-setting imports, or China's steady buying. Demand is real, supply is tight. Yet the paper price barely budged until recently. That's stage 2 in a nutshell: pressure building, reality tightening, and a price system trying and failing to hide it. Stage 3 is where something finally snaps. A technical glitch, a political move doesn't matter. The moment the system stumbles, everyone rushes for the real metal, not the paper promise, and suddenly there's not enough silver to go around. And honestly, it looks like we're already in this phase. Just look at November 28th, 2025. The CME group, the backbone of global derivatives, went down for over 10 hours because of a server cooling issue. While the system was offline, silver spiked to about $56.72, hitting an all-time high. When trading came back, The spreads were blown out over $1. That's what stress looks like in a market built on paper. Then things got even stranger. COMEX filings revealed that JPMorgan reclassified roughly 134 million ounces from registered deliverable to eligible not deliverable. In plain English, they pulled about 9% of available silver off the table right when physical demand was peaking. That's not random, that's positioning. And if that weren't enough, go back to October 2025. Silver lease rates hit almost 30% annualized. That only happens when people are desperate, willing to pay massive interest just to borrow physical silver. You don't see numbers like that in a healthy market. You see them when a squeeze is forming. Fast forward to December 6th, 2025, silver sitting in the $59 range, up roughly 98% year to date, the strongest run since 1980. That's stage 3, the break, the cracks show up, liquidity disappears, real metal gets scarce, and the whole paper system starts shaking. Stage 4 is the eruption the moment everything blows open. Prices don't just rise, they detonate. Shorts get wiped out. Institutions that moved early walk away with the win. Everyone else scrambles. And honestly, that's exactly where I think we're standing, right now. To understand how explosive this phase can be, you have to look back at Texas. 1979, the Hunt brothers, Nelson and Williams, saw silver at around $6 and noticed something nobody else wanted to see: inflation rising. Demand outrunning production. And a perfect setup forming. So they bought around 200 million ounces, roughly 1/3 of America's silver supply at the time. By January 1980, silver skyrocketed to $49.45, an insane 800% move in just 18 months. Banks panicked. COMEX literally changed the rulebook overnight, no new longs, liquidation only. Then came Silver Thursday, March 27th, 1980, the crash, the hunts were wiped out. But here's what matters. The squeeze was real, the shortage was real, and that $49 price wasn't a fantasy. It took rewriting the entire game to stop it. Now fast forward to today and flip the script. What if the main buyer isn't two over-leveraged billionaires, but the bank that helps make the rules? That's the scenario that should make everyone pay attention. The pattern from 1980 didn't disappear. It just found a bigger player. Stage 4 isn't coming, it's already warming up. If you think 1980 was a one-off, look at 2008, the same pattern showed up again, just in a different market. Paper mortgage securities collapsed, and suddenly everyone wanted something real collateral, real assets. And when that stampede happened, look what gold did. It went from around $720 in October 2008 to roughly $1,923 by September 2011. That's about a 167% jump. Why? Because when paper breaks, money runs toward whatever isn't imaginary: gold, silver, anything physical. But here's the part nobody wants to talk about. The central banks never fixed the root problem. They didn't repair the system, they just inflated a bigger one. Reports say they printed around $16 trillion globally, bought their own debt, crushed interest rates to zero, and pumped the paper markets even further. And that's how we got to today, a silver price consolidating just under $60, sitting on top of the same structural weaknesses. Except this time, everything is bigger. The money printing is bigger. The deficits are bigger, the paper market's bigger, and the pressure underneath way bigger. This isn't the prelude to a small correction. This is deja vu, except scaled up. So let's talk about where this could go if the pressure finally breaks. JPMorgan once projected silver at around $38 by late 2025. We already blasted roughly $21 past that. Citibank called for $36, $39, and those numbers are dust in the rearview mirror. A few independent analysts like Lawrence Leopard see $75 to $90 by the end of 2026. And even those estimates assume the paper market holds together. That's the conservative scenario. But let's step back and look at history. Silver hit about $49 in 1980. Adjust that for inflation, and you're talking roughly $170 in today's dollars. Now look at where we are at $59, and the fundamentals. The deficit is worse, industrial demand is higher, and the paper market is exponentially bigger. Then there's the gold-silver relationship. Historically, the ratio tends to hover around 15:1. Today, it's sitting near 72:1. If that gap snaps back, just reverts to the historical mean, some analysts believe silver could land near $280 per ounce. That's not a fantasy number. That's simple ratio math. And I'm not saying that's guaranteed. You don't need conspiracies to see this just mean reversion. one of the most boring and reliable economic principles out there. But here's the real nightmare scenario. What happens when holders of paper silver start demanding actual delivery? What happens when they realize the metal needed to back those claims might not exist? What happens if pension funds, sovereign wealth funds, and everyday investors all line up for physical silver at the same time? That's the moment that turns a price rally into a full-blown eruption. That's the moment that keeps people like me awake at night. Now here's where the timing gets crazy. On December 9th and 10th, 2025, the Federal Reserve held its latest meeting to decide interest rates. And according to Bloomberg, going into that meeting, the odds of a rate cut were sitting at a massive 87.2%. If they cut, the dollar usually weakens. And when the dollar weakens historically, gold and silver rip higher. Look at gold right now, trading around $4, 212 per ounce. Some analysts are calling for $4, 500 to $5, 000 by mid-2026. And silver has always followed gold, but it moves harder, faster, and with way more volatility. So yeah, the Fed meeting may have been the spark. The structural deficit is the tinder, JPMorgan's positioning might be the accelerant, and a stressed paper market, that's the explosion waiting for a trigger. Here's the wild part. Physical silver is still available for now. Dealer premiums are rising. Some dealers are reporting delays, but you can still buy it. That window doesn't stay open forever. Because when a paper market starts breaking and futures contracts risk not being deliverable, premiums don't creep higher, they explode. You could see 30%, 40%, 50% over spot, maybe more. We've already seen it before. During the 2020 COVID panic, silver traded around $28, but physical coins were selling for about $45, a 60% premium. Now imagine that with silver at $100. You don't have to believe it'll happen tomorrow. But this isn't some 10 years from now scenario either. The Fed meeting is the first domino. Industrial demand is non-stop pressure. COMEX inventories keep draining. The countdown is already running. Here's the part almost everyone gets wrong. This entire situation isn't really about silver. Silver is just the symptom. The deeper issue, the one hiding in plain sight, is the dollar. COMEX registered silver is reportedly sitting around 113 million ounces. If that number ever slips below 50 million, the system could hit serious stress. At the current rate of drawdowns, that could be 6, 12 months, maybe even sooner if people start rushing for physical metal. But again, that's just the pressure point. The real story goes back to 1971 when Nixon closed the gold window. From that moment on, the dollar became pure fiat backed by confidence, momentum, and political muscle, but not by anything physical. And after more than 50 years of nonstop printing and deficit spending, some economists argue the true inflation picture has been blurred by changes in CPI methodology. And now, the bill might be due. Gold sitting at $4.200, silver around $59, energy prices surging, institutional money rotating into alternatives. Everything in the market is flashing the same warning paper currencies are under long-term pressure. And scarcity matters again. And when you line up all the major assets with real scarcity, silver starts looking like the most undervalued one in the entire system, undervalued compared to gold, undervalued compared to its industrial importance, undervalued relative to how much the money supply has exploded. Remember, it took 45 years for silver to break the old $50 high from 1980. That's 4.5 decades of what many describe as suppression, accumulation, coiling, and now here we are, $59 and climbing. The Hunt brothers were early, they got crushed, but they weren't wrong about the fundamentals. Now imagine a player with patience, a player with deeper pockets, a player with the system at their back instead of against it. That might be JPMorgan today. They don't need to force a squeeze. They can just wait for the math to do it for them. The signals aren't scattered anymore. They're stacked on top of each other. Record prices, structural deficits, banks hoarding physical, paper markets cracking, the Fed meeting in days, geopolitical pressure everywhere. This isn't coincidence. This is convergence. Stage 1 setup done. Stage 2 expansion done. Stage 3 break happening right now. Stage 4 eruption loading. You don't have to take my word for any of this, but history has a habit of repeating itself, especially when people ignore it. I'm not a financial advisor. I'm just someone who's been tracking these patterns long enough to recognize the shape of what's coming. Silver isn't on its way. It's already here. And 6 months from now, you'll either be the person who understood what was unfolding or the person wishing you had paid attention. The choice is yours. And remember, the events of the December 9th Fed meeting are still rippling through the markets. If you want to follow this as it plays out, hit subscribe. I'll be covering every move in real time. And I genuinely want to know what you think. Does silver hit $100 in 2026? Drop it in the comments, because this might be one of the biggest financial stories of 2025.